Welcome to the latest ETFs.com Expert Series webinar. Today's topic is the changing advisor landscape, effective use of the ETF model portfolio. This is a complimentary ETF.com webinar courtesy of BlackRock's iShares Connect program. I'm John Swolf, the Director of Conference Content at ETF.com, and we are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's largest ETF conference. Joining me today are Russ Cleary of Signature FD and Jim Shockman of Conestoga Wealth Partners, as well as Katherine Earhart of the iShares iConnect program. Katherine is the head of iShares iConnect program and other customized solutions within BlackRock's global client group. Her team has helped shape the ETF investment strategist market since 2008, when it launched the iShares Connect Guide to highlight these unique strategists and the related program to connect them to advisors. Russ joined the investment team at Signature FD in 2010. He assists the investment management team at Signature FD with fund manager selection and comprehensive portfolio management analysis and implementation. Jim Shockman is a certified investment management consultant and senior advisor at Conestoga Wealth Partners, part of the Wells Fargo Financial Network in Gig Harbor, Washington. He has been an investment professional since 1987. Before we go ahead and get started, I'd like everyone to know that you can ask questions at any time during the webinar in the window at the lower right of your screens. Also, the slides, presentation, and information about CE credits will be emailed to you within 24 to 48 hours of the conclusion of this webinar. So let's go ahead and get started. The financial advisory landscape is consistently evolving, or constantly evolving, I should say, from the days of stock picking to the use of mutual funds to fee for advice. There's another sea change underway, as advisors are turning more and more to ETF strategists for asset management. This area of the ETF marketplace has exploded in recent years, with over $90 billion in assets under management. ETF strategists are changing the face of the advisory business. That does not mean that this business is without its challenges. With more and more players entering the space, it's becoming more and more difficult to do due diligence and distinguish between the different managers. And questions remain on how I should deploy these managers in my portfolio and what is it going to mean for my clients. Lucky for us today, we have 3 experienced executives who can help us get our heads around these complicated challenges and more, as well as the choices in the contemporary world of money management. So without further ado, I'd like to introduce Katherine Earhart of the iShares Connect program. Katherine?
Yeah, thanks, John. I appreciate it. Appreciate the time today, and I'm excited to have both Russ and Jim join me today. I'm going to just talk a little bit, just for a brief couple minutes on the iShares Connect program and what we've seen in terms of the landscape, and then we'll go through a couple of slides that really sort of explain the growth in this space, and then I'll turn to both Jim and Russ to we'll dig a little further on the Q&A then. So the iShares Connect program, we are currently have 112 firms in the program and about $95 billion in ETF assets. We started in 2008, as John indicated, and at that point we just had $5 billion in ETFs and 25 firms participating. So the growth has really been tremendous over the past 5 years, and we're estimating that it's going to get to $120 billion by the end of 2015. So, I think it's given the opportunity and the growth we've seen is been in the tactical space, but we've also seen some very steady growth with other types of strategies, whether it's, sort of a global macro asset allocation strategy or a, more of a strategic model that's redefining the efficient frontier. So what I thought I would do is then turn to, our next slide, which is really on advisor challenges. Advisors that we're hearing, and this is, from different studies, this particular one has some insights that we gathered from the Charles Schwab 2014 Advisor Index, the Schwab study, the Advisor Outlook, as well as the TD Advisor Index study. And really, most RAs are indicating their biggest growth barriers being unable to devote sufficient staff time to business development. And, with overhead expenses and the need for increased marketing, client services, what we're hearing, we meet with advisors one-on-one or in roundtables. And what I just heard the other day, one of the biggest challenges an advisor was facing was just really keeping their client calm in terms of market volatility. And so I think most people on the phone are familiar with that discussion that they have to have with their clients, which is stay invested, the market is volatile. And I think just taking the time out to have those conversations does take time away from other things that you need to do in your practice. So that's really the gist of the webinar today, is really to talk to two advisors, very experienced people who are dealing with these challenges, and we'll get to hear from them on how they're dealing with the challenges. Let's go to the next slide, which is really talking about the advisor's time. Again, as I mentioned earlier, there's internal demands, increasing complexity of just running the practice, whether it's from regulatory compliance challenges, decreasing margins and increasing costs. There's definitely a challenge to pricing concerns. I've heard some advisors, reflect the fact that, they're feeling under pressure for the way they charge their advisory fees. There's also a need for increased level of diversification of assets. External demands, increased client time. Most successful advisors spend about 62% of their time client-facing. And it feels like that sometimes needs to increase more when there's extremely volatile situations happening in the market. So you can see the pie chart on the right, how the advisor would spend their time from a Cerulli Associates report. So the majority of time in green is really, spending that time on client acquisition, which is, an important part of continuing to grow your practice. So there isn't a lot of time left to manage the portfolio. And so as we will hear, more specifically from Russ and Jim on this, I'm gonna start with Jim first. And Jim, I'm gonna ask you, how did you, first start using ETFs in your practice, and how do you use them today?
Well, first of all, good morning or good afternoon, everyone. Thank you, Katherine, for having me here. I think I started using them probably, maybe 6 or 7 years ago. And I used it primarily just as a kind of a one-off to access, some commodities, gold, things like that. I'm currently using some more specific ETFs for some of the alternatives, commodities, things like that. I've also started to look at and use some of the tactical managers. But I would say probably 7 or 8 years ago is when I started to use them, started to take a real serious look at them.
And Jim, I didn't actually have you describe a little bit, I know John introduced your background to the audience, but I didn't really have you describe your practice in a little more detail. Do you want to just give the audience a little bit more information about what you do and your firm?
Yeah, absolutely. We're a small firm. My past history was at Morgan Stanley until about 2 years ago. There's 2 of us here. I primarily manage the assets and work with client relationships, and my other partners primarily client acquisition. And my background, I started using money managers back in the early 90s and asset allocation and modern portfolio theory. And so I actually spend a lot of time, trying to build a portfolio, put together the allocation, and primarily I still use active managers, and I've just kind of filled in the allocations a little bit on the fringes with the ETFs. Our practice is a smaller practice. We have probably, maybe 120 households. And our focus really is on, for many years it was bigger is better, and we've kind of focused more on just fewer clients and really spending a lot of time. We start with financial planning, figure out what it is the client's looking for, and then really just put everything into those clients. We like to be real accessible, and with that low number of households, it's pretty easy to spend whatever time they need to spend. And so we've kind of gone from bigger, more, to really kind of limiting our size.
Yeah, and I guess just to provide more background too, Jim, you're here on the West Coast with us as well. You're based in Washington. Gig Harbor, I believe, is where your offices are located.
Correct.
Great. Well, was there anything more you wanted to say, Jim?
No, I think that's about it.
Okay. So we'll turn to Russ. Russ, why don't you just give a little bit of background about your role, elaborate on what John Swilf already provided, and then I'll ask you a follow-up question once you've done that.
Sure. Thanks, Katherine. Our firm's been around for 18 years, and we're out of Atlanta, Georgia. And our firm is structured in three silos, is the way that I like to describe them. We have 15 advisors that handle the day-to-day client relationship management aspect, and they're supported through a team of individuals on the investment side, a team of individuals on the financial planning side, and then we have what we call our products and solutions group. So we have insurance that we handle in-house, mortgages that we handle in-house. And so our firm was really founded on the belief of providing holistic wealth management services. But we view very passionately that a strong investment process and platform is integral in that. So even though we hold ourselves out as a holistic planning firm, we have, I would consider, a fantastic investment team. My role on that team is to really source, our role as a team in general is to source, execute, and implement investment strategies. And similar, kind of a similar story to Jim, our firm used no ETFs in the early stages, so we were all actively managed solutions, and that's evolved. We view ETFs as kind of a disruptive, but a healthy disruptive force in our industry, and it's allowed us to do a couple of things. It's allowed us to drive down the cost of our underlying portfolios. It's allowed us to get quote-unquote cheaper beta exposure, and it's also allowed us to be a bit more tactical in our portfolio. So our utilization of ETFs has increased, and we still present ourselves as being product agnostic, but our portfolios now are comprised of 40% passive ETF, 35% active, and then the remainder amount, 25% roughly, is in private-oriented investments.
Great. So I think what's important is the evolution of your firm, Russ. I think what's interesting is if you look at how an advisor allocates their time, on the pie chart, the fact that you guys have a centralized investment management team allows for that, that the advisors in your practice to spend that 37% on acquisition. So can you talk a little bit, you said 10 years ago you used no ETFs in the portfolio. That's where you are now. But it seems like, when you're using ETFs in your practice, you are kind of doing that screening. Can you talk a little bit more about that process and how you manage the portfolios?
Yeah, sure. So kind of two aspects to that question. The first is how we've structured the growth of our firm. So really through the first 14 years of our firm, all of our growth was organic. So we brought in talented individuals, and they worked their way up through the organization and took on more and more responsibility. And the idea behind that was we really wanted to institutionalize our process that would allow us to go out and potentially make acquisitions or bring on other advisors to launch off of the platform that we've built internally. So the first 14 years of our existence was really organic-oriented growth. In the last few years, the institutional process that we've built internally has allowed us to go on and bring in outside advisors. So we've added, we call them strategic strikes, but we're looking for a good fit culturally and a good fit professionally, and someone that, meshes well with the processes that we've built. And so we've brought on 3 advisors over the last couple of years from other firms and allowed them to plug into the process that we've built and grow their book. I mean, the important thing that you point to is we really want to create a leverageable process to where our advisors can spend the most amount of their time working with clients and prospecting for new clients. We recently finished an acquisition of a similar firm here in Georgia in the third quarter of last year. It was roughly a $200 million RIA, and culturally it was a great fit for us, and it allowed them to plug into our investment team and our planning team and grow from there. And then the other aspect of that question is, what is our process when we're allocating portfolios? And our process has not necessarily changed over that period. We view it as kind of a four-step process. There's determining an appropriate strategic asset allocation for our clients, and that's goals-based, it's cash flow-based, and it's risk tolerance-based, and it's getting them into the right amount of growth-oriented assets or the right amount of long-term income-oriented assets. And from there, the investment team runs model portfolios so that a client coming in with unique needs from a liquidity or a risk tolerance standpoint has a unique portfolio that's built for them. We then make tactical adjustments, so our team is constantly looking at the marketplace and looking at where we perceive to be the risks and where we perceive to be the opportunities, and we make on average between 5 and 7 tactical shifts within our portfolio in a given rolling 12-month period. And that's really, we do have wide bands around our strategic targets, but we know that we're not running a hedge fund, and so we're never going all to cash, or we'll never be 100% in equity if our client's tolerance doesn't call for that. But we are looking to be somewhat tactical in the areas of the marketplace where we're investing. The third step to our process is the strategy or the manager piece, and that's the one that really has evolved, and that's the area where ETFs have been so disruptive in a positive way. We still spend some time on manager due diligence. We still have a meaningful part of our portfolio to active managers in areas that we perceive to be less efficient, but the ETFs have allowed us to either impart a top-down view and get clean, cheap beta exposure, or quickly make those tactical adjustments. And then the fourth step is just kind of monitoring and rebalancing. So that's our process, and that's how ETFs, we've integrated them into a process that really hasn't changed over the last 18 years.
So Russ, what I thought would be a good follow-up to that for the audience is what there's a lot to stay on top of. Your role is definitely heavily focused on the investment side, but what resources do you use to stay on top of things?
Yeah, we read a lot. So we have 10 individuals on our investment team, and we have some research that we pay for, so we do subscribe to some sell-side research, and that's really to try to make sure that we're getting enough macro views from enough impartial voices to where it helps formulate our view. We utilize industry tools. We utilize Morningstar, ETF.com from a product research standpoint, but it's really collaborative. So our process is we meet on a weekly basis formally to review our portfolios and our exposures relative to where we see the marketplace, and we try to be somewhat contrarian when looking at the world, and we'll make like I said, we tend to make 5 to 7 shifts in the portfolios based off of that. Everything, the way that we describe our process to clients is we're very valuation sensitive, so we want to make sure that we're not overpaying for assets. We're conscious of technicals and sentiment because we believe that helps us from a timing perspective when we enter and exit markets, and we're macro aware. So we try to be careful that we're not making investment decisions based too much on the macro environment because the correlation between that and market returns can be less than you would assume, but we are aware of what's going on at a macro level.
Mm-hmm. Great. Well, I thought it would be a good opportunity to turn to Jim, because Jim, you run your practice very, very differently, and in that you choose third-party managers. And can you talk a little bit about how you screen and perform due diligence on the managers that you choose?
Yeah, I basically, again, I came from a kind of the modern portfolio individual money managers, and I started using them back in '91. First of all, I try to leverage Wells Fargo. They have a consulting services group, and they do some due diligence on the managers, so that's kind of one of the starting points. Try to perform some, basic qualitative screening. We look at and quantitative. We look at the manager's philosophy about investing, how they kind of view the world, and their philosophy of how they invest. We look at their process, how they carry out and execute their philosophy. Spend a lot of time looking at the people that are making the decisions. And then, of course, we also screen for performance. But I think performance, in our view, it's kind of a lagging indicator. And so we believe that if you spend the time looking at the manager, understanding their process, understanding how they're making decisions, that in the long run, that'll ultimately pay off. Like to listen to the manager and see that there's consistency, in their philosophy. There's how they describe their philosophy. We look at their communications, the people, that are their salespeople, and then and make sure it's consistent with what we've heard from the consulting group. We also like to look at their holdings, make sure that their process and holdings match up. And again, performance is important, but it really is kind of a lagging indicator, in our view. And once we hire a manager, we think it's important, unless there's some material change in one of the, the philosophy, process, or people, to give the manager time before we make a decision to sell. And our feeling there is there's a pretty good possibility of getting whipsawed if you start chasing performance. And then we use Morningstar for the mutual funds, and then we also use the ETF.com tools on the ETF side of things.
Great. I think what's interesting as well, Jim, when we had first started talking about your practice, was also how you communicate investment changes to your clients. Since you are very hands-on, you want to have deeper partnerships with your clients. Can you talk a little bit? I know you run a discretionary practice for the most part, but can you talk a little bit more detail about how you do that communication?
Yeah, I guess the starting point of that is just, coming up with a plan that they agree to and that we agree to, make sure it's in writing. Basically, we're trying to define what success looks like for that client. Then we spend a lot of time talking about potential things that could happen with the markets, the ups and downs, kind of the upside and downside of the strategy. The idea really is to try to, have a conversation about these things ahead of time before they actually happen. Because I think it's a lot tougher to have a conversation about something going wrong while it's going wrong. And so we spend a lot of time really kind of doing use the analogy of a lifeboat. We talk about what will happen, what we're going to do, the steps we're going to take. And I think that performance expectations, and again, we spend a lot of time talking about what success looks like. And I think that managing expectations is a real important part of what we do. I think most people don't like unexpected negative surprises. And we spend a lot of time just talking to the clients about, even on the managing part of it, even though we have discretionary portfolios, they know what we're doing ahead of time. And again, so that there's no surprises. And if we spend a lot of time talking to them about what we're doing, what our plans are, when we'll be changing, why we would change. And so, very seldom do I ever get questions about what we're doing because we've already had the conversations ahead of time. But I think it's real important.
Go ahead. Sorry. No, go ahead.
No,
So what I thought was interesting too, Jim, was just, the fact that you do stay on top of it and try to manage expectations so well is that, in times of crises, it feels like, I think you said, it's easier to kind of manage the conversations. I'm sure you still have to have conversations when the market's volatile, but have you found that it's easier because you do that up front?
Absolutely. And I've kind of learned that the hard way over the years. But I think having a conversation ahead of time is so important, because then it's not new information. It's not a surprise. They feel like there's more control, even if there really isn't. But yeah, it really makes all the difference in the world, because I think if if you've done a bad job of managing expectations, you have too much risk on the table, it's too late to find out about it when you run into that sort of a situation, because I think if somebody panics and sells out, I think it's pretty much, a lot of times I think it's, my experience anyway has been that it's pretty much game over. It's never the same after that.
Mm-hmm.
But yeah, absolutely, it makes a huge difference talking about these things before they actually happen. And that's really the key, is having the discussion. It's too late if you wait until it's actually happening.
Yeah.
It just doesn't carry as much weight.
Yeah, agreed. So let's turn to Russ and ask you, Russ, about how you handle client communication practices in your firm, and any sort of specific examples that you have around last year's sort of run up in the equities market.
Sure. It goes back to the idea of creating a leverageable process for our advisors. So we have 15 advisors at our firm, and we have around 700 client relationships. And so on a per advisor basis, we have a relatively concentrated book of business. And so it is high touch. We do communicate with our clients often. And we do have our subset of clients that are more curious about what's going on from the investment portfolio standpoint, but we try to provide communication that allows advisors to be in front of their clients and to communicate with what we're doing back at the home office. Specifically, our investment team writes a weekly talking point package where we communicate what were some of the most important things that we saw in the markets last week and what those implications are for our exposure and for our client portfolios. We do a full performance review on a weekly basis with our advisors to give them some perspective on how our portfolios are performing relative to benchmarks. On a quarterly basis, we write a newsletter, and as part of that newsletter, there's usually a 3 or 4 page higher level, more macro-oriented view on our take on the markets. And to accompany that, we do a quarterly chart book that has between 10 and 15 pages worth of what we consider to be important economic or investment slides and our take on those. And anytime we make a model shift, anytime we make a tactical adjustment in our portfolio, we'll typically publish a 1 or 2 page update on what we're doing and why. And like I said, the application for that really only applies to a subset of our clients. We run fully discretionary portfolios, and the bulk of our clients delegate to us for a reason. And so not all of our advisors use these, but we really want to create an environment that is supportive of them being able to be in front of their clients and utilizing the tools that we put out from an investment team level. We didn't really talk about too much how we keep, I failed to mention one of the tools that we also use, and it's iRebal. So iRebal is the technology tool that our portfolio management team uses to trade all of our client accounts. So that's another tool that we use. We're really looking to drive dispersion across all of our clients down to as minimal as possible. And the tie-in with that is we really want our communication from an investment team level to be as leverageable across as many clients as possible. So we have very little dispersion across all of our advisors' books. It's all centralized, and it's all handled essentially at a home office level at the investment team.
Great, thanks, Russ. I actually kind of to follow on with your comments around the client communications. I thought it would be interesting to ask you about, at the beginning, you talked a bit about the practice, your practice at Signature FD, but research that's coming in from Cerulli and TD Ameritrade's recent institutional survey indicated that more advisors will be offering comprehensive financial planning in their practice, and that end investors also have indicated that the biggest factor in choosing an advisor is the advisor's ability to take the time to really understand their needs and their goals. You mentioned that one of the areas in your firm was financial planning. Can you talk a little bit more about what you offer in this area and its relevance to kind of that trend that we're seeing?
Sure. It's an important part of our business. So I mentioned kind of the 3 silos: investments, planning, and solutions. Most of the professionals that we bring in on our investment silo progress towards the CFA track, and almost all of our professionals on the planning side progress towards the CFP track. And the importance of that is that we really strive our folks to continually evolve and educate, because we do believe that planning and investments integrate very closely. So from my seat as an analyst within our firm, my sole focus is to make sure that the portfolios are performing well, and that we're adding alpha for our client portfolios. But by and large, this, I'll call them the softer aspects of the relationship: the cash flow planning, the estate planning, tax management, education funding, executive comp analysis. Those are all extremely important, and arguably more important in the eyes of our clients. And so we built our firm with the belief that to the extent that we can be great on investments and great on planning, then that gives us a competitive moat, if you will, and would allow us to do great work for our clients, most importantly, but secondarily, it allows us to protect our business as well. So it is a focus of ours. I do think that clients are getting more conscious of the importance of planning and how the planning process informs the investment process. So we've invested heavily on both sides. And I think the other point to that is the role of technology within the planning process. So you can look at technology one of two ways: either as a competitor to what you're doing, or a way to supplement what you're doing. And so we embrace some of the financial planning technologies. We've incorporated those into our practice, and we view that we kind of sit at the intersection of that technology and true face-to-face advice. So it's our job to interpret and to utilize the technology and give clients confidence based off of that.
Yeah, I think you actually make a really great point, Russ, because I think there is, we see a growing trend in, technology coming in and really kind of, there's some concern by advisors that there's, technology may replace them, but I think, we all agree that there is that sort of human element to it of, coaching you and helping you make and drive those decisions. So I like that you see it as an opportunity, the technology as an opportunity to really almost leverage your firm in terms of a competitive offering. One note I was just going to make to the audience was that you can certainly send in questions via the chat feature. We have a couple more things that we're going to go through here on the call, but please feel free to send in any questions that you have. One thing that I was gonna ask Jim about is, your practice. You've indicated that you're at an optimal size in AUM. How do you see your practice evolving over the next few years, and how do you expect to use ETFs in the future? Jim, I think you might be on mute, so
That's a great question. Thank you. I think earlier in my career it was really about, when I was with Morgan Stanley, just about size and more clients and scalability and being more efficient and bringing in more assets. And I think my shift has really gone to more of a, using these things. It's almost like the investment part of it it's kind of like brushing your teeth. You expect to get enough performance to deliver what the clients want. And I really see ETFs as just maybe a more efficient way to deliver that. I still have some, pretty major questions, and frankly, I don't use them as much as I probably will in the future. It's still limited, but, I think ultimately I can see that as, I agree with Russ, it's a good disruptive technology, potentially. And I think the bigger ones are pretty straightforward. I still have some unresolved questions about some of the inner workings, the replication, counterparty risk spreads. But I think, ETF.com, going to that conference was really, for me, was a really good thing. I heard some really great things, and they're talking about some of these issues. So I think they'll work themselves out. But I would say practice-wise, I could see it as being a very efficient way of capturing the returns that the clients need at a minimal cost.
Yeah.
As far as the size of my practice, I don't really want it to be more than 60 households, and I guess I don't really ever see it being any more than 60 households. So I think the challenge for us is just to find ways to continue to add value, and I think the technology is a way that behind the scenes, if we can leverage it properly, it's a great way for us to be able to add more value.
Agreed. I think what's interesting, Jim, is that you do use an active manager who uses ETFs in your practice. Was there something about how they use ETFs that attracted you, or is it more just the strategy itself, and you didn't really care that they used ETFs to implement the strategy?
Well, I think it's kind of a combination. I mean, I really believe in, I wanted to hire somebody that I thought, in this case, it's a manager that has a very flexible strategy where they can, do something different than what my other managers do. And so the fact that they're using ETFs, I don't think I'd try to do that myself, but the fact that they have the expertise to use the ETFs and use them in a very simple way to carry out their strategy is appealing to me. And so I think for me, that probably will be the first step. I'd probably use ETFs more that way than I would actually directly going out and trying to buy them myself, especially when you get into the more esoteric asset classes. But no, I think that's an area I think that would grow potentially. Yep.
So I got a question that I have for both of you, Russ or Jim. What kind of advice would you have for a young advisor entering this business? We were joking earlier before we joined the call that it seems like all the young people in the industry were at the most recent ETF.com conference. What advice would you have for somebody coming in about, specifically kind of thinking about both the end clients and how they might build their practice from the investment perspective? So I don't know, Russ, if you want to take that first.
Sure. I think that the business itself is very broad, even though the different ways that you can be involved in the business all, the end objective is to serve our clients. For me personally, when I was getting into the business, I knew that the investment side of the organization appealed to me a little bit more so than the other aspects of the relationship, and so I tried to find a fit that would allow me to be a little bit more influential on the investment policy. But I would say that there's enough flexibility within our business if you're if you're more inclined to handle the planning aspects of the relationship, that I would focus on doing the CFP, and vice versa. If you're more interested in the investment track, there are multiple designations that you can go to do that. But I think education, especially early on, helps build credibility as a professional. And so whether it's those designations or whether it's just reading and continuing to get better at your profession, I think is one thing that I would say. And then secondarily is really network and reach out to people that have been in the business to find out what they like and what they don't like, and see where your personality kind of gravitates towards, and then work towards carving out a niche in that side of our business.
Great, thank you, Jim. Anything that you would want to add to Russ's comments?
Well, I think Russ had some really great ideas. The one thing that I probably would do would be to look for some sort of a mentor. I spent quite a few years as a manager, and I've had a few people that I've seen that have succeeded, and I think that's real important to find somebody that you can learn from. And it's a great time for a younger person to be in the business, because I think the average advisor is certainly in their 50s, so there's a huge opportunity there. But I would definitely, the only thing I would add would be maybe to look for a mentor.
Great. I think the ways to educate yourself. I know that there's tons of information that on the internet out there that's free. So I think ETF.com, there's plenty of webinars that you can take after recorded webinars, and I know iShares.com has plenty of educational material as well on ETFs. One question that came in from the audience, and maybe we'll start with you, Russ, given that you use both ETFs and mutual funds in your practice. The question came in is, why would I use ETFs instead of mutual funds? And I know that you use both, so I thought maybe you could elaborate a little there.
Yeah, sure. So I think the important thing first would be to draw the distinction between, I think there is a nuance between just ETF versus mutual funds and active versus passive. We've seen kind of a proliferation of ETF strategies that have been launched that are different than market cap weighted, equal weighted, fundamentally weighted. And so are those active or are those passive? There's a little bit of gray area there. I think for us, we were looking at it as a firm that initially invested all in active strategies, a lot of that being in mutual funds. We really did some heavy analysis on, are we overpaying for market-like returns? And so I think that the trend that we've seen is almost, an hourglass shape in nature, in that you've got the truly actively managed mutual funds. There's metrics out there that try to quantify that, but, one of those is active share, the high active share, the high tracking error, the mutual fund managers that are really concentrated, that are taking differentiated bets from the market. I think there will continue to be a space for those types of managers. And it's really those in the middle where you're getting market-like exposure with very similar sector weights to the market that people are really reevaluating whether there's value in the management fee in those strategies. So for us, we looked at really squeezing down those strategies where we wanted market exposure. So we do want broad market exposure to U.S. equities. We want broad market exposure to certain areas in the international markets. We can get those through low-cost ETFs, and for us, we still felt like there were unique pockets of opportunity where managers could take advantage and create alpha. And so for us, the hurdle has gotten higher for us to hire an active manager. We still think that there's value there, but the default for us is getting the exposure first and then finding an active manager if we feel like one exists in that space. So end of the day, to us, it's cost-driven and not overpaying for something that you can get for cheaper. So we still use mutual funds, but for areas that are more efficient or you're just looking for beta exposure, we've migrated our book towards ETFs.
And we're sort of seeing the same trends at BlackRock as well. The core of the portfolio really trending towards ETFs. The outer hourglass side is really towards the alternatives or alpha type of generating mutual funds. Jim, I think your practice predominantly uses only mutual funds, although interestingly enough, they're mutual funds with ETFs inside. Do you have anything that you would want to comment on that, ETFs versus mutual funds?
Yeah, I think there are a couple of things. One, I think Russ hit most of the key points there. One of the reasons why I still like mutual funds is actually because of the human element in the decision-making process. And to me, I kind of see that as a way to reduce risk. If you have different people making different decisions, the idea is that they're not all going to make the same mistakes at the same time. You don't get a bunching up of risk. But I think it kind of depends on the asset class, like Russ was saying. I mean, more efficient asset classes, I think an ETF is fine. If you get into a less efficient asset class, I'm not sure that that's the way I would go.
Okay. Thank you. Go ahead, John.
Katherine, this is John from ETF.com. We're seeing a couple questions come in on our side as well. And one of the main questions we're seeing today is where can I learn more about these ETF strategists and get a sense of where they're accessible to me as well on my platform or for use within my portfolios?
Yeah, that's a great question. We definitely track ETF strategists. So these are firms that build models that are predominantly using ETFs. There's a couple of different places you can go. Certainly, the ETF.com website actually features some strategists' articles. I think twice a month you guys have interesting articles from those strategists. You can also go to iShares.com, and as an advisor and a financial professional, you can register, and you'll be presented with 112 firms that have that display their model portfolios to you, and then they'll tell you which platforms they're available on. We also offer some due diligence materials as well. So we have a couple of worksheets that you can use that help you kind of go through each of the areas that both Jim and Russ referred to in terms of how they go about deciding what managers they're going to select. So we also offer that. I think the interesting element is that our worksheet goes in a bit about the ETF, like if you're going to have ETFs inside of a portfolio, what additional due diligence should your manager be doing for you on those ETFs. So that's sort of the added nuance to that due diligence worksheet. In terms of other ways to gain knowledge, certainly the ETF.com conference this past year, John, was you guys had a whole track dedicated to learning more about strategists. And if you're not, wanting to go to a conference, you can certainly attend webinars. We offer them through iShares as well, so we can certainly add you to our mailing list on those type of things. And then, certainly reaching out to if you're with a platform, whether it's, one of the custodians or if it's a broker-dealer, you can certainly reach out to your home office, because we do work a lot with the home offices around education. We send them our guide materials on a regular basis. Every quarter we refresh our information. And then lastly, you can actually do some additional research through Morningstar. So they have a whole industry guide that you can go to look at performance. And if you register on their site, there is a free registration, and you can get access to that as well. And they have information on the holdings and the model portfolios. I don't know, Jim or Russ, if there was anything more that you wanted to add there. I know Jim, you've worked with your home office to do some of that due diligence. Was there any more that you wanted to add there in terms of education that you can get from your home office?
Yeah, I think it's just ask questions, call them up and tell them what you're trying to do, and and they're pretty good about giving you some advice on what, where to look or who to call or who to talk to. And I think, the one comment I'd make on that, I went down to the ETF conference and I wasn't really sure what to expect, but I think that was, I was pleasantly surprised by how good that was and how much information you guys had there. So I think you did a really good job, and I think it was worth spending a few days to go down there.
And it was nice to go to Florida in the winter, I think, for some of the folks on the East Coast. So, and John, are you guys going to do that again next year?
Yeah, absolutely. January 25th through the 28th, Hollywood, Florida, Western Diplomat, same place, same location. Different content, but again, the same educational focus will take place as we have in the past.
Well, I think what's nice for Jim, I know for CE credits, you're a SEMA designated designate, so I think getting you guys have CE
Yep,
credits.
There's plenty of CE credits available for all the different designations and things like that. So certainly if you need to get your CE credits, you can get quite a few. I think there was up to 21 available this past year in just about 3.5 days of content or so. So obviously a lot of opportunity to fulfill those requirements, network with peers, industry thought leaders, things along those lines. So certainly more than just ETF knowledge is available there. There's certainly, like I said, opportunities to connect with peers, hear what others are doing within the industry, and kind of stay on top of trends as well.
I think what's nice, too, is that a lot of the ETF strategists are there as well. So there's an opportunity to meet them in person, and almost, a lot of advisors I've talked to like to meet with their strategists in person. And so I think being able to have, 10 meetings all in the span of a day where you're actually face-to-face with a strategist and asking, the tough questions around their investment process, there's a real opportunity to do that. And I always like to do things where I can pack a lot all into one small window. So certainly there's an opportunity to do that at the conference. I think we're almost out of time.
Yeah, we have time for probably one more question or so. And one of the ones that we're seeing come in here is there any sort of trend or some sort of kind of natural progression as to how these ETF strategists are being incorporated? Is it as a core holding? Is it more of a tactical approach? Kind of how are people wetting their toes and getting comfortable with using these ETF strategists?
So we've actually seen it from an iShares Connect perspective. We've seen it actually both ways. I think some advisors get comfortable with a particular strategist approach and process and want to fully sign up for the strategy as a complete portfolio. And so, it's usually a strategist that does, complete, macro asset allocation. And so they'll put a portion of their total end investors portfolio in that strategy. I think what I've seen some advisors do is that they do see it as a complete portfolio solution, but they'll test it out with a couple of accounts just to feel like they're comfortable with the communications, with the engagement with that manager, and just to kind of wet their feet. And then they'll start to move more of their accounts over once they're comfortable. Other advisors that I've spoken to prefer to use some of the strategists in the satellite portion of their portfolio because they are active managers, and so they sort of treat it like Russ was talking about earlier, where they treat that as an alpha generating portion of the strategy, and then they may use ETFs at the core, or they may use something else that their home office platform has helped them research. So that's kind of the different ways that we're seeing it done. I think what's interesting is that for smaller household accounts, so you may have a large account from one particular client, but then you also are dealing with the smaller accounts within the household, and sometimes just using an all ETF model is a less expensive, more operationally efficient solution. And so we've seen it that way. We also have model portfolio solutions at BlackRock that that many advisors follow. They're paper models, and you can certainly learn more about that on the BlackRock website as well. So those are kind of the three different areas that I'm seeing people use the strategies.
Great.
Yeah.
And
go ahead, Russ.
I was just going to add one area that our firm has launched into is kind of an outsourced CIO engagement with some other advisory firms, and so I wanted to put that out there in that if that's of interest to anyone on the call, it's a little bit more of kind of a concierge type of customized outsourced CIO engagement, but we do have relationships with a handful of other advisory firms that philosophically align themselves with how we manage assets, and so that's an option as well. A little bit different than the model ETF driven strategists, but something that we found helpful for advisory firms that, to your point of earlier on the call, want to focus a little bit more of their time in other areas, but still want to have a good kind of open dialogue with the outsourced CIO. So that's one area that our firm has found some success as well.
Great, thanks, Russ. That is helpful too. That is actually a fourth sort of trend, and so thank you for bringing it up because that is something else we're seeing as well. And in the institutional space, interestingly enough, one of the data collection providers we work with, eVestment Alliance, has told us they've noticed a trend in the institutional space with more people researching and wanting to know more about ETF portfolios. So whether that's in the pension and foundation space or it's with institutional level consultants, I think they're recognizing the increased use of ETFs as well, and the expertise that is being developed by people who've maybe left a larger firm and started their own practice, but have this deep knowledge and deep expertise. So I'll hand it back to you, John, to see if there's any more
Well, I don't think we have any more questions coming in from the audience, so I certainly would like to take this opportunity to thank Katherine, to thank Russ and Jim for your insights. I think it was very, very helpful for those on the call to understand how different practices and different advisors are using ETFs, how they're melding them into their practice, as well as kind of what they need to be aware of if they want to go ahead and start to take this approach themselves. As a quick reminder, again, the presentation, information about CE credits, everything like that, that will be mailed to you, or emailed to you, I should say, within the next 24 to 48 hours at the conclusion of today's webinar. So please keep an eye out for that on tomorrow or Monday. And then the other thing that I would say, and at the sake of sounding like a commercial, if you are in the tri-state area, we actually will have the first ever Etfs Strategists Conference this coming June 26th in New York City. And what we've done is basically gather the best and brightest from an ETF strategist standpoint to bring them all together for one day to discuss the current global macro environment. So you'll hear everything from fixed income to emerging markets to the future growth here in the U.S. So if you ever did have a need to want to learn more about these ETF strategists, you can get a lot of them in the same room, as Katherine said, kind of on one day, and ask all the questions you might have for them through live Q&A and in personal meetings as well. So certainly plenty of opportunity to get to know the ETF strategists. But again, thank you to Jim, Russ, and Katherine. We certainly do appreciate the time. I want to thank those that dialed in as well. We know it takes you away from your daily practice, but we certainly do appreciate that. So on behalf of all my colleagues here at ETF.com, I'd like to wish you all a great afternoon. Thank you.